On today's episode, we're talking about the general U.S. economy, USDA trade estimates for the upcoming report, and a rise in condition ratings across the Midwest for corn and soybeans. Hello, everyone, and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing great. How are you today, Will?
Not too bad. There's some rain in the forecast here in kind of eastern slash central Texas from that hurricane coming up through Houston. So I guess I'm in for something. We'll have to wait and see.
Yeah, when you started talking about rain in the forecast, I thought you were going to completely, just highlight over the fact that you're in a hurricane. But glad to hear you're doing all right. Stay safe down there. I think the southern part of Missouri is going to get some of the remnants of that, but it's going to bring some rain to the Ohio Valley region. Those crops certainly need some rain. So.
Yep. So maybe some good things coming out of the hurricane systems here. Giving a quick rundown on some of the prices that have been kind of in decline generally across the board for this week. Looking at that September corn contract down 14 cents at 393. December 24 corn down 13 cents at 407. September 24 soybeans down 11 cents at 1096. November 24 soybeans down 12 cents at 1099. Soybean oil on a cents per pound basis, one of the only bright spots in the market week over week, up 2.89 cents per pound at 48.87. Soybean meal on a short ton basis here, down $6.80 per short ton at $328. The nearby wheat contract was down 20 cents at 570. That July 2025 wheat contract down 12 cents at 629. And then that West Texas Intermediate crude oil contract down almost $1 a barrel at 81.43. So, Ben, a lot of losses coming into this week, mostly on the moderate side, but a lot of that we saw coming after the holiday break and rolling into the start of this trading week.
Yeah, pretty much all of this came on Monday of this week after the markets, as you mentioned, kind of recovered from the holiday shortened week. It really wasn't, they did trade on Friday, but I think a lot of people went ahead and took Friday off. So low volumes on Friday that allowed the markets to really kind of react today. We probably would have had across the board increases had it not been for Monday. The sentiment really changed given the widespread rainfall that happened over the weekend, but then also just the outlook of weather over the next, let's just say 10 days right here at the heart of pollination for corn and good vegetative growth for soybeans. That hurricane that you're dealing with that we talked about on the onset here, I think is a big part of this, providing some moisture to areas that desperately need it.
And it will be interesting just to see how that kind of spreads throughout the country, coming up from the southwestern region here, kind of approaching into the southern Missouri and over into toward Ohio and the eastern Corn Belt as that kind of swings back east. So like you said, maybe some improvement in condition coming in. We'll talk about some adjustments in crop conditions coming up in a little while. But first, Ben, let's talk about the general U.S. economy. We've seen some shifts and some new numbers here coming out on U.S. jobs. We're seeing more openings than maybe expected. We're seeing some increases maybe in jobs created due to, being attributed to these recent reports. So what does that really mean when we see maybe the amount of positions open above expectations and the direction that means for the economy?
Yeah, so this last week and then looking ahead to this week are two important weeks, I think, really, as we think about the direction the Fed might head with interest rate cuts. Again, I'm not anticipating interest rate cuts here in July. The market is currently factoring in an interest rate cut in September, a 70% chance of an interest rate cut. I remain skeptical there. If it happens, all of our viewers can tell me, Ben, you were wrong. Part of the reason why I remain skeptical is I think the Federal Reserve is going to pivot towards a neutral stance for a period of time, waiting for some of these measures to kind of get closer to their target. But you're right. Job openings for the month of June came in at 8.1 million. That was above expectations, still below where we were, at the height of the pandemic, but well above where we were pre-pandemic levels for employers looking for workers. And so the demand is still out there for U.S. labor. And that's one indicator. The second indicator is the fact that hourly wages rose again in June to 3.9% month over, on an annualized basis. And That's down from where they were in May. So year over year in May was 4.1%. So a little bit of slowing in that hourly jobs rate, but the Fed wants to see that down closer to 2%. It's hard to get inflation back down to 2% when hourly wages are still increasing close to 4%. So both of those, I think, signaling, some strength, gives the doves, or the bulls, if you will, a reason to be, kind of in that camp of holding interest rates steady. The reverse of that is the jobs report. So even though we still produced, or we still created 206,000 jobs in June, which was above expectations, we saw a very sharp revision to both April and May by a collective 111,000 jobs. So, the current month, or the most recent month, was up 6,000 relative to expectations, but we saw a loss of 111,000 jobs in those back months. So that provides a little bit of fodder for the other side.
Yeah, well, and going back to what you were saying earlier, talking about the increase in wages and how that, is going to kind of continue to drive things forward. It's almost like you see two horses in a match race where one is trying to push the other one to go a little bit faster. And the Fed doesn't want to, pull back on interest rates, like you said, until that kind of slows down. But looking at specifically more back to the agricultural economy, looking at ag commodity prices, well, at the ag commodity outlook here, with managed money traders, there's a lot fewer positions being taken right now, and it's been shifting downward for the last several weeks. Ben, what is this telling you when you see these funds take just limited positions within the market?
Yeah, so this is something that always, I think, is intriguing to everybody. Prices are largely a function of supply and demand. However, we do get these instances where managed money accounts sometimes highlight or exacerbate moves, if you will, for a very, very short period of time. There's evidence to say that it doesn't really last all that long. However, there is kind of an understanding that they're sentiment traders, right? And so when the news is kind of bearish, traders tend to sell off and try to take advantage of that fall in market prices. And of course, that can exacerbate the price a little bit, or at least that's always the theory. There's little empirical evidence to suggest that's actually the case. But now I'm sitting here trying to say that this is important and it's kind of neat to watch. But there's this big debate whether it's an indicator of prices going forward or if it's just representative of what's happening right now. And I think wherever you're at in that discussion, what we can agree on is that given the decline that we've seen in commodity prices, it's probably not all that shocking to see that managed money positions are incredibly short. In fact, when we think about corn, given the delay, we could actually be in the delay in reporting. We could actually be in all-time net short holdings of corn contracts, meaning that there's a lot of traders out there that would make money if the corn price continued to fall. And certainly, the fact that we're this, managed money traders are this short, you could say hanging out there on a limb, that they're that far out on the limb during the summer months, July, when we tend to have a lot of weather is just kind of amazing. They're very comfortable out there, and that's helped, kind of keep the rally going, I guess, if you will.
Well, it's one of those deals where it almost seems like the expectation for pressures that could develop to maybe push the market higher would be slow to develop. So maybe those managed money contractors are slow to really buy back positions. But I guess we'll have to wait and see. But talking about that, some reports that are coming out that could push the market around a little bit. We have trade estimates coming out on from USDA coming up this week. Coming off the previous reports of some increased corn acreage and stocks there, especially leading to more supply on the books. Ben, what are your expectations for this trade report? How do you think USDA is going to react to maybe move around the numbers to fit that extra supply into the picture?
Well, the acreage numbers are pretty straightforward. USDA will take those acreage numbers that we saw in the June acreage report, and they'll plop that right into the new crop balance sheet and make some adjustments on the supply side, largely keeping yield the same. There is precedent that they that they have changed yield in July. I think personally, I don't expect them to change yield here in July. They have before, but I don't think we'll see that here in July. So just on the acreage side alone for corn, larger production. Then you go and you say, okay, what do we do about this larger grain stocks number. How is USDA going to kind of rectify that? Well, they've got two options. One, they can go back and increase the size of last year's corn crop, which they won't do until September. The other thing to do is say, okay, we didn't actually feed as much corn for livestock during the past quarter or the last year as what we thought we did. And so they'll go in and they'll make some adjustments to that livestock number, reducing livestock feed demand down. Of course, that could have impacts moving forward. So in theory, what we're going to see come Friday is, I shouldn't even say in theory, what we're going to see come Friday is we're going to see a larger production number for corn. We're going to see a larger total supply number for corn. And then the question becomes, how do the demand categories then respond to that? We're going to see lower prices. Lower prices tend to mean more use. However, our corn export numbers for the new crop marketing year certainly don't suggest that we're going to see all that much, more corn exported. So that's a potential limiting factor that I do think we'll see some, an increase in new crop corn exports. What do you do with feed demand? The fact that you potentially feed demand this last year was overstated. Can you really increase feed demand for next year to use up supply if we didn't use it this year? And then, of course, corn ethanol has been kind of constant. I mean, it's kind of that one that doesn't move a whole lot. So at the end of the day, I think what happens is we see a little bit of an increase to corn exports, a little bit increase to feed use for the new marketing year. But the big increase is going to come on that ending stocks number.
Yeah.
And that's going to continue to weigh on prices for the new year. So that's corn. Soybeans, kind of goes through a very similar type of methodology. Of course, we don't have as much extra supply that we have to work through the balance sheet. And so I think that one will look maybe a little bit similar to where we had in June. So I think the big one's on the corn side, the big, balance sheet here to look at U.S. domestic corn.
Yeah, well, I'm talking about the sectors there where that supply could be almost shifted to or used up, to pencil out nicely on paper. You look at the feed use sector is one that it's kind of tough to really justify, the over adding into that sector specifically, historically looking at things like the size of the cattle herd and other factors too there, which I mean, it's all relative and all, comes out in the end that, everything gets squared away. But Ben,
I'll add one thing if I can. If I'll add one thing. So as a reminder to everybody, that category is feed and residual use. I'm guilty of this too. We tend to think of that as just feed, which we do believe a large part of that is feed. But the residual gets a lot bigger the more supply we have. So as you can increase supply, that residual within that feed and residual category also grows. So just a reminder that number can increase even though we don't anticipate extra feed. It can come from the residual category on larger supply.
Well, Ben, hitting on the last point here and talking about the factors that might be kind of pushing down prices slightly, we're seeing a slow tick up in crop condition ratings here, just very light here, looking at the second week of July. So really, Ben, looking at the outlook, how does that impact the near-term price outlook for commodities across the board?
Well, so it is not normal. It is a rarity for us to see conditions actually not only be this high in July, right? So we started out from a very high level. We've come down from that high level as conditions kind of waned over the last month. But we're still at very strong levels for conditions. So that's one that's unusual in July. The second thing here is to see an increase in July. And we certainly saw corn and soybean conditions increase, that good to excellence rating. Of course, we saw the composite score, if you will, also increase for both and be above, historical averages. And so, the crop is progressing. There's a lot of conversation happening around, this excess moisture that we've seen in the upper plains and then hail in Nebraska. And the market seems undeterred by any of those. And so where could we actually start to see this start to impact the market? Well, my anticipation is we see this start to impact the market in the December grain stocks report. That might be where we get the first look at, hey, we don't have as many bushels as what we thought for a variety of different reasons. It could show up in some of the yield reports, the production reports that start in September with those field level where they actually go out and survey the field. But I'll take Iowa here for just a case. I think with all the water that we've seen in Iowa, we've seen quite a bit of leaching or loss of fertilizer. that can have the impact of a moderate drought or a minor drought just in terms of a yield potential. So maybe a little bit bigger of a yield drag than what we currently anticipate as we work our way through the harvest season. But certainly crop conditions look good. There's a lot of vegetative growth out there. It's deep green in most cases. So we'll just have to see. The one crop we don't talk about a lot, and I just want to mention real quick, is U.S. cotton. I think this plays a role into southern soybeans like Louisiana, Arkansas, Mississippi, but then also corn in Virginia and North Carolina. It's been very dry in the southeast part of the country. The cotton conditions ratings continue to show that. And when I think about potential for production of corn and soybeans in the southeast, it's limited, and that could mean that imports of Brazilian corn and soybeans into the southeast part of the United States to meet feed needs there are a possibility as we work our way through the winter.
All right, Ben. Well, we've talked about quite a bit today, and looking ahead to the rest of the week, even hinted at some of the things there, but what should farmers and ranchers really be paying attention to?
Yeah, it's a big week. I mentioned at the beginning of this about how we're kind of in the middle of a 2-week period here for the macroeconomic picture. The end of this week, both Thursday and Friday, we get 2 important inflation reports I think are going to be very closely watched and could have big market moving impacts. The consumer price index report on Thursday, the producer price index report on Friday. We get all those USDA production and supply demand reports on Friday at 11 a.m. Central Time. And then next Friday, not only is it the NOPA report for the month of June, the National Oilseed Processors Association soybean crush numbers will be included in that. But as a reminder to all farmers that listen, Monday is your reporting deadline for acreage to the Farm Service Agency. So kind of a fun week, a different collection of data than what we normally have.
But quite a bit going on. All right. Well, viewers and listeners, if you'd like to learn more about us and what we do, you can check us out at brownfieldagnews.com. You can also find information on our sister program there as well, the weekly livestock market update. Ben, thanks for all your knowledge and information you give to the program. And I'm Will Robinson on Brownfield.